We were looking at financial market equilibrium, where we were considering the case where the economy has a banking sector along with the central bank. In this case, we said financial market equilibrium is given to us as where supply of central bank money is equal to demand for central bank money. Here we talked about what is central bank money, then we talked about the supply of central bank money. Now we want to look at demand for central bank money. Now we know is central bank money, high-powered money, or monetary base is the sum of reserves and currency. So demand for central bank money is equal to demand for currency plus demand for reserves. Because like we know, central bank money is sum of reserves and currency. So demand for central bank money would simply be the sum of demand for reserves plus sum for demand for plus the demand for currency. Now the figure below shows the structure of the demand for central bank money in more detail. So now we'll get back to this figure. Now we're going to start from the left-hand side. So this figure helps us understand the structured demand for central bank money in more detail. We'll start to the left-hand side. Now, in the case where the economy has a banking sector that collects deposits, so you just don't have the central bank, you have commercial banks too. Now we know people can decide whether to keep the money in the form of currency or deposits, right? So now you have two options, right? You can keep the money in the form of currency or checkable deposits. When you just have the central bank, you have to keep your money in the form of currency. Right, so when people can hold both currency and deposits, now your demand for money involves two decisions. The first decision is how much of your wealth do you keep in money and how much do you keep in bonds? Then there's a second decision now. You can also choose the type of money that you hold, how much to hold in currency and how much to hold in deposit accounts. Assume you decide to keep a fixed proportion of money, C in currency, and from here it follows that you keep 1 minus C in deposit accounts, right? You have only two options, currency or deposit account. So if you keep C in currency, then 1 minus C is kept in deposit accounts. So demand for currency in this case is given to us as C times MD, where C is a fraction of total money demand held as currency. C is called the currency demand coefficient. And demand for deposit accounts would just be 1 minus CMD. So if we go back to this figure, so your money demand can either be kept in the form of currency or can be kept in the form of deposit accounts. And here C is the fraction of total money demand held as currency. So demand for currency is CMD, demand for deposit accounts is 1 minus CMD. So this essentially gives us the first component of demand for central bank money, which is demand for currency. Because like we said, demand for central bank money is demand for currency plus demand for reserves. The first component is this demand for currency, which is CMD, where C is the fraction of total money demand held as currency. It's called the currency demand coefficient. Now let's move on to the second component, which will be demand for reserves. Right? Second component is demand for reserves. Now we know that banks have to hold reserves against deposit accounts. We already talked about this. Reserves are those part of deposits that bank keep on hand that are not loaned out. So the demand for deposit accounts leads to a demand for reserves by banks, because when you receive deposits, a certain part of it is kept as reserves on hand. So demand for deposit accounts is what's going to lead to a demand for reserves. Now here let theta be the reserve deposit ratio, i.e. the fraction of deposits that are held as reserves. So the second component of demand for central bank money, which is the demand for reserves, is given to us as theta dt, because theta is that fraction of deposits that bank hold as reserves. So demand for reserves is theta times dt. And we already looked at KDD is 1 minus CMD. Substituting it over there, we get our demand for reserves. So if we go back here, so we know our demand for deposits leads to a demand for reserves because you have to keep a certain fraction of deposits as reserves. So with demand for reserves is theta times our demand for deposits. Theta is a reserve deposit ratio. And the demand for deposits is just 1 minus CMD. So as a result of this, this is a second component of demand for central bank. So the demand for central bank money is equal to demand for currency plus demand for reserves. Demand for currency CMD, where C is the fraction of total money demand held as currency. And demand for reserves is theta times demand for deposits, where demand for deposits would be 1 minus CMD, because you're either keeping currency or you're keeping deposits. So if currency demand is CMD, demand for deposits would be 1 minus CMD, and theta is our reserve deposit ratio. And from here, now we can factor out an MD. So this gives us demand for central bank. Now, since HT is C plus theta 1 minus CMD, and given that money demand is decreasing in the interest rate, we talked about why. Because interest rate here we're talking about is the interest rate on bonds, which is your opportunity, which is alternative way to keeping your wealth in the form of rather than money, right? Because when you're holding money, you're giving up the interest you could have earned. So it's the opportunity cost of holding wealth in the form of money rather than interest-bearing bonds. So here we know HT is C plus theta 1 minus CMD, and MT is decreasing in the interest rate. So HT is also negatively related to I. Thus, when we draw the demand for central bank money, with central bank money on horizontal axis and interest rate on vertical axis, it's drawn as a downward sloping curve like this.